All right. Matt, the mortgage guy here. Exciting week in mortgage. The Fed met this week. They concluded their meeting. They come out with their report, and then Jerome Powell comes out and speaks to the press. I literally just got done watching it. I'm going to explain to you what they said, what they've done, and more importantly, what to expect in the future, right? I'm going to try to bring it as simple as terms as possible so you understand it as a consumer, as a real estate agent, as a fellow loan officer, what it means for you in the future. All right, thanks for watching. Matt, the mortgage guy here, mortgage broker, somebody who tries to bring you mortgage real estate information in easy to digest, quote unquote, simple terms, right? So let's just jump right into it. Jerome Powell and the Fed met for the last couple of days. This March meeting resulted in a 25 basis point hike from the Fed of the Fed funds rate. A couple important things that come out of this meeting is a dot plot, their plans on how many times they're going to increase rates for the rest of the year. Because to be quite honest, not only with the 6 hikes that they anticipate for this year, but the 25 basis point hike that we saw this morning, if you're a sports fan and you remember Dennis Green, coach of the Arizona Cardinals, talking about the Bears, this is probably 10 years ago, they are who we thought they were. And in my words, the Fed did what we thought they'd do, right? This was expected. This is something that the market, for the most part, already priced in, right? They already knew the Fed was going to increase the Fed funds rate. It was just a matter of, is it going to be 25 basis points or is it going to be 50? They knew the Fed was going to increase that rate multiple times this year. Was it going to be 5, 6, or 7? Those were the questions, right? So all this stuff was expected. What could potentially be a little bit market moving. And as I look here on Wednesday afternoon, I see 41 basis points to the negative for mortgage bonds. So mortgage rates got slightly worse today. This is likely because of what the Fed said after in the question and answer on how they plan to run some of these mortgage-backed securities off of their balance sheet, right? Because they've got trillions. All right. So let me back up for a second. Let me, make it as simple as possible. So first and foremost, I understand it, right? The Fed is tightening monetary policy. They are increasing rates on purpose with a goal of taming inflation. Now, when the Fed speaks and Jerome Powell speaks, he talks about the dual mandate, the two things that they want to do. I mean, basically what they're in place to do. Restore price stability and maintain or create a strong and stable labor market. That's the dual mandate. Those are the two things that they're tasked with doing. They change or manipulate monetary policy, raise interest rates. They, buy mortgage-backed securities. They buy, treasuries and whatnot, or they sell it, right? Like those are the things that they can do to affect monetary policy that is going to raise or lower interest rates, tame inflation. What we saw on this last run, right, is inflation ran rampant. So an important thing to think about is their target inflation number is 2%. As of the last reading, it was 7.9. A lot of people will argue that it's higher than that. But whatever the case, it's much higher than their target of 2%. So they need to continue to do things, tighten monetary policy, raise interest rates to bring inflation down. What I want people to understand is that this isn't a one-time thing. This isn't 25 basis points in March, we're all done. It's not even a 6 times in 2022 and we're done. It's going to take more than likely 18 months of this to really tame inflation. The Fed's own words today, their projected inflation for the end of the year is 4.3%. So think about that. 25 basis point hike in March. They plan on doing 6 this year. At least that's their guesstimate for now, right? So some 25 basis point ones. A lot of people think the next one or the one after might be 50 basis points. So the Fed funds rate might go up by 2% this year. They still expect inflation to be 4.3, meaning they're going to have to continue to raise the Fed funds rate next year. So they're going to do a lot of pushing on interest rates. As a consumer, you're going to pay a higher interest rate on all kinds of things, right? Mortgage included. And I wouldn't expect it to slow down. I wouldn't expect it to like, hey, we're going to creep up to 5%, then we're all done. Into next year, they're going to have to continue to do that because 2% is the goal, is the target for them on inflation. And they need to continue to press to lower that number, right? If it's 7.9 on paper and we all feel it's worse and they're projecting 4.3, if we get to the end of the year and it's still 5%, they might have to throttle more, right? They might have to press a little bit harder on the gas. So be prepared for that as a consumer. It's going to be more expensive to borrow, right? And that is essentially the Fed saying, hey, we've only got a few levers that we can pull. We know we can affect demand. If it's more expensive to borrow, there's going to be less demand for borrowing, right? That's going to tame inflation. So I think another couple things they said that stuck out to me that folks should be aware of is that they've already got a plan. They've got a plan that they're going to implement. And I think by the May meeting, it's probably going to be public. It's probably going to talk about how they run mortgage-backed securities off their balance sheet. That is going to have effect on mortgage rates on the market as well, right? So regardless of whether the next bump is 25 basis points or 50 basis points, the talk about running bonds off of the balance sheet is going to be a market mover. I can guarantee you that, right? Interesting things they said too, just talked about how strong the labor market is, how they think the economy is doing great. They think that they can tighten monetary policy and they can be relatively aggressive and not run us into a recession. Some people would disagree with that. Some people think that this monetary tightening, this raising of interest rates is going to cause a recession. But Jerome Powell and the Fed, seem to view the economy as doing really well and paints a fairly rosy picture, right? The employment market, one of the stats that he brought up was like for every job opening, there's for every unemployed person, there's 1.7 job openings. And some of the unemployment numbers or people leaving work was just because they left one job to go to another higher paying job, right? And so the metrics they're looking at for the labor market seem to be pointing, in the direction of a strong labor market, wage increases, and so now they're going to have to work on the price stability thing more than anything else, which you got to tame inflation. A lot of folks think that the 25 basis points was not strong enough by the Fed, but we'll see. It sounded like some of the Q&A, and I didn't listen to all of it, was pointing towards, we're going to do 25 now. It's a little, get us warmed up, but we'll do 50 on one of the future meetings. So we will see. Takeaway as a consumer, know that more of this is coming. So we've been on an upward trajectory for mortgage rates. You should expect to see higher rates for home equity lines of credit, for car loans, for everything. But for the purposes of the mortgage broker in the mortgage space, I expect rates to go up. I expect it to not be something that, dies down anytime soon, because the Fed's going to continue with this tightening of monetary policy, continue with this increases in interest rates, not just through the end of 2022, but all the way through 2023, in my humble opinion. If we can help you in any way, please feel free to reach out. greatmortgagebroker.com. This is only relevant for the next week or so, but I'm going to put a link down in the comments for Financial Literacy Week. We want to empower you through education at UMortgage. My hope is that we're going to do more of these, but this is the first one, March 28th of 2022, runs for a week long, all kinds of great classes to help you become more financially literate, make better decisions about your finances. It's absolutely free. We're trying to spread it to as many people as possible. So if you see this in the next 10 days, grab the link below, share it with a friend, come check us out. Getting pre-approved or anything like that, greatmortgagebroker.com. Thanks for watching, guys.